Welcome to today's webinar. My name is Ed Meisegland, and I'm the managing partner here at Indiana Business Advisors, and I'm also uh, a business appraiser. And what we do here at the brokerage as part of our engagement is we do an awful lot of financial analysis, because what we want to be in a position that when we're presenting to business owners, that we can look at your business or as business sellers, or we can look at the seller's business as if through their eyes. So today we're going to go through that. We're going to talk about recasting your financial statements in a fashion that is indicative of how a buyer is going to look at your business. So we'll go ahead and get started now. So first, we have recasting, and that's the term. Some people call it normalization, some people call it recasting, but what we're trying to do here is we want to recast the financial statements. So we're looking at income statements and balance sheets. Those are the two primary documents that we're working with, and what we want to know is, what does those two documents, or your financial statement, or your income statement and balance sheet, I want to know what they look like from a buyer's perspective. And so again, we're looking at it through the buyer's eyes. And what does that mean is, and we're going to talk a little bit about it here in just a minute, about how they're going, once, how you operate your business is not necessarily how the next person will. So at the end of this webinar, we're going to go through an exercise with a real business that we've sold, and I'm going to show you how to do it. And then we're also going to give you that spreadsheet so you can apply it to your business. And the other thing that I guess I want to draw your attention to is, look, unsolicited offers come. A competitor shows up at your front door, and you may need to be in a position to know this number. And these numbers that I'm referring to is these recasted numbers. So if you say, and we'll talk about it here in a second, about the different levels of cash flow, you have to make sure that you, as the business owner, and the buyer are speaking the same language. So why do we recast? Again, we're looking for the true earnings of the business. And the reason we want to know about this business is, we want to, most businesses or smaller businesses have operate their companies in a fashion that suits their lifestyle, not necessarily as if it was an investment. And there's nothing wrong with it, but country club memberships, kids on the payroll, things like that aren't necessarily something that the buyer is going to need. So we recast those financial statements. And so we identify, and the next thing is, it's back to what kind of earnings we're dealing with. And larger businesses deal with Ebitda. Ebitda stands for earnings before interest, taxes, depreciation, and amortization. It's predominantly for your larger transactions, and you'll hear that, or if you do any kind of research, you'll see Ebitda a lot. That's an important number. The smaller businesses, again, use what we call SDE, seller's discretionary earnings. And we talked about that last time on our last webinar, about knowing your earnings. And I have an additional slide to kind of refresh you on the various different levels of earnings. We also want to know what the fair market value of the assets are. And when I say assets, I'm talking about the tangible assets, because it's important for a couple of reasons. One, you need to know, what is the true value of the assets you're acquiring, and two, you also need it from the standpoint of, for tax consequences, when the buyer acquires your assets. Because typically in at the business brokerage and lower middle market, these are asset sales. So they're acquiring assets. So there's a negotiated component to this where the 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 buyer allocates a certain amount to tangible assets, and that starts their basis for um, redepreciating those assets. And then the seller, from a tax standpoint, gets that's the taxable event for them. It's called depreciation recapture. We're going to plan on talking about taxes in another webinar down the road, but that's why it's so important that we understand the balance sheet and how to appropriately position those assets, the economic assets. And then lastly, we want to know what we're going to include or exclude in the sale. And when I say that, is not just, often we deal with business owners that come in and say, I want to sell my company. And it's not synonymous with what selling your company means. Often business owners come in and they're assuming they're buying everything, as in a stock sale. I'm selling to you the everything that's on my balance sheet, everything that's on my income statement. When in fact, it's only a certain components of the business that go, and the business owner retains the entity itself. So we need to, when we recast, we're going to go through assets and liabilities here and determine what's included or excluded. So here's what we know. We know, and every accountant worth his or her salt is minimizing taxes. We're okay with that. We just need to do some forensic accounting and back that out so the buyer can understand how much that they have available. So many expenses that we look at are discretionary, non-recurring in our excuse me, got tongue-tied there. Are discretionary, non-recurring, and what that means is, for example, a lawsuit. It doesn't happen every year. At least we hope it doesn't happen every year. And in that case, it's a non-recurring event, and that's cash flow because it doesn't happen all the time. So we want to look at those expenses that are embedded on the income statement that are unlikely to happen again, or discretionary in nature. And when I say discretionary, meaning, just by virtue of being the owner, you can adjust or you can expense various expense discretionary expenses, that like country club memberships, gym memberships, cars. We have had people that have kids on the payroll, things to that effect, that they aren't active in the business. The cash flow is critical because we have to get that number, and I can't stress that enough, is that understanding that number will enable you to have a meaningful conversation with any buyer, whether it's through our brokerage or not. You have to understand that particular number, because that number drives your value. And then lastly, we want to reflect the assets sold. So here's a refresher on the types of earnings. So we have net income, we have free cash flow, and I'll give you the definition of that. There was a question that came through the chat box that somebody wanted to know the definition of free cash flow, so we'll get that for them. Earnings before interest and taxes. Ebitda just is EBIT plus depreciation and amortization. Normalized cash flow is nearly synonymous with free cash flow. Ebitda plus officers comp, often known as the next one, adjusted Ebitda, but sometimes they're split out. And then lastly, adjusted cash flow, which we'll talk in great deal here in just a second. So cash flow. I was telling you about, there's a difference between cash flow and seller's discretionary earnings. Cash flow especially free cash flow, is, as the definition, as the name implies, it's free. Free cash flow means, if I'm a passive investor and I'm writing a check to invest in this company, everything's paid for. Management's in place. I don't have to do anything. All I have to do is take a dividend or a distribution. I don't have to do anything. That's what free cash flow is. And so its definition is the operating cash flow less the capital expenditures and net working capital. That's free cash flow, or the changes in net working capital. That's what the acronym NWC stands for. And it's that free cash flow, and it's a little bit, we're getting a little bit in the weeds on this. This is predominantly used for the income approach to business valuation. And when I say that, because the income approach is the methodology or the approach, especially the discounted future earnings method, is used to forecast the investment into the future. And again, it assumes that the principle of substitution. Why should I invest in ABC company if I can invest in Google and have a little risk, but I'm assured of liquidity and perhaps distributions down the road? Whereas ABC Corp, it's a privately held company. I don't know when I'm going to get my money. So that's what free cash flow is for. It's predominantly for the income approach. So I hope to the person that asked that question, that's satisfactory. If not, just reach back out to me and I'll go into a little bit more detail. Ebitda. So earnings before interest, taxes, depreciation, and amortization. So again, as I said, these are predominantly for larger companies, and it represents earnings after a management salary. Okay, adjusted EBITDA is earnings before interest, depreciation, and amortization. It tends not to have a lot of the discretionary non-recurring expense embedded in it. Okay, because it's a larger business, it should be able to operate with clean books. And so you have EBITDA plus officers comp. Okay, SDE. This is what we're going to spend the majority of the rest of our time on. So we have SDE is EBITDA plus officers comp, and we'll talk about rent and some of the normalization expenses that we use. And it's predominantly for Main Street or business broker. I mean, it goes anywhere from your small mom and pop businesses up to, I mean, we always include SDE. We tend to get, maybe 5 million-ish is probably on the top end where SDE is applicable. But for us, when we're doing our work, we do those levels of value, and I'll show you, it's in the spreadsheet, so you too will have it. And then we, like I said, we keep talking about this normalization. Normalization is, there's different expenses, especially like in rent and inner assets that are owned outside of the company but leased back to the operating entity. So we have to normalize all that. So SDE answers 3 questions, and this is one of those takeaways that if you're taking notes, this is something you want to keep in mind. Number 1, how much money, and if I'm looking at it from the buyer standpoint, how much money can I put in my pocket? Okay, whether it's W-2 or whether it's through distributions, it doesn't matter. But how much money can I put in my pocket? How much debt can I service? And when I say service debt, somebody asked me, what does that mean? That means how much debt can the company itself have, meaning in purchase price, because chances are they're going to, the purchaser will obtain a loan to acquire the company. Well, how much debt can that company have, maintaining the covenants within the loan, and still pay them a fair wage? That's what the debt coverage is, or how much debt can can I service? And then lastly, and this is a distant third, but it's still material for our purposes. The first one is how much of a return of, rather than off, of my investment can I get? A return of my investment. So my initial cash outlay, if I'm the buyer, how much can I get it back? Okay. And the second thing, how much of a return on my investment? So not only am I putting money in, but I also want to know how much of a return on my investment can I get? So here's the calculation, and like I said, we're going to go through an exercise here in a second, but we start with our net income up here. Okay, let me see if I can get a highlighter. So we start with net income here, and we add the interest expense. So why do we add interest? Remember a number of slides back, I said chances are this is going to be an asset sale. So the buyer is going to get their own loan. It doesn't matter what what your debt structure is. They're going to get their own to acquire the business. So however much in debt that you have is immaterial to the buyer because they're going to have their own capital structure. So that equals EBIT, or earnings before interest and taxes. Okay, chances are there's most companies at this level aren't C corps, where there's a taxation event that occurs. Normally it happens at the shareholder level after all of this. We also add our depreciation and amortization to get our EBITDA. Okay, we then add direct officers comp. So that's W-2, and this is for one owner. Now we run into situations where business owners are there's multiple business owners. Okay, we add one, whoever is the president, CEO, and whoever we're working with, or I'm sorry, whoever is operating the business, we add their compensation. Now, if there's family members or other people involved, or partners or whomever, and they're exiting the business, what we have to do is we have to adjust their compensation to fair market value. So if for example, we had a client that two brothers, each of them were making $400,000 or $200,000 a piece. Well, we could replace one brother for $100,000, so we picked up an additional $100,000 in cash flow. So direct officers comp includes your W-2 compensation for one owner. So that's W-2. The company paid payroll tax on that employee, or on the owner. I didn't list, but included our health benefits. Company paid health benefits to that owner. If there's any life insurance, paid to that owner or paid on behalf of that owner. Again, those are indirect compensation. So you think of it that if I didn't run this through the business, I'd have to pay it myself. Well, that's what we're looking at for officers comp, or direct compensation. Next, discretionary non-recurring expenses. So here in a second, we're going to go through this income statement. I'm going to show you all of the areas that how you look for discretionary or non-recurring expenses. This last one, for those of you that have rent or that you have real estate, most of the businesses that we work with, there is an operating entity that holds the business, and there is a real estate entity that leases the real estate back to the operating entity. Oftentimes, the real estate entity has an increase that increases the rent in order to minimize the tax on the operating entity. Okay, so there tends to be some adjustments that are going on, and there's nothing wrong with it, but from a buyer's perspective, I need to look at the business as if I am going to lease it from whomever at fair market value. So if we have an entity that is paying $200,000 in rent each year, but the fair market rent, if I was to rent it, as a third party or other elsewhere, and it's only 100,000, well then my rent adjustment would be $100,000 falling to the bottom line. So those are the areas that we adjust on a regular basis. So again, when we're looking at the income statement, we're looking for one time or one time, or are they normal expenses? Is it required to generate revenue? And is it discretionary? And we talked about this fair market. Is the rent fair market? Is other leases fair market? There's times that we have been in situations where the entity also owned the equipment and rented it back to the operating entity. Well, we have to adjust for that. And is it reasonable? And the biggest thing is it defensible? If it generated revenue, and you're saying, well, let me back up. We have a number of sellers that come in here and say, well, you don't need this. Well, it generated $500,000 in business. So by me not needing it, what happens if I take it out? And so regardless of what we do, is it defensible? So I'm gonna forego. Well, let me draw a couple things. Draw your attention to a couple things here. This is if you're a business that has coupons that you offer or promotions where you get advance, where you receive income, but at a future date you do the service, we have to adjust for that. And years ago, and this is more of a horror story. The good news is we got it fixed before any damage was done. But we were selling health clubs, and so the health club owner sold a bunch of prepaid memberships. Give me $200 cash, you get for a year. They go to sell it, and they're going to, and we'll talk about it in a second, they get to keep the cash. Buyer has to perform the service, but all of the members have prepaid their dues. So they have to provide the service without any income. So hopefully you see that there has to be an adjustment to reflect, that liability is real, and the buyer is entitled to some of that in prepaid income. So again, that I want to draw I want to draw your attention to that. I also want to draw your attention that we have to adjust the balance sheet to reflect fair market value of the assets. Okay, other consideration. Again, we have to document, or you have to document where it is, what we removed and why. We have, and this is kind of to summarize. We often, when we get into situations, we have we have to be in a position, because the documentation is so important, because not only the buyer is going to rely on it, the buyer's bank going to rely on it, the accountant's going to rely on it. All these people downstream from the seller have to rely on it, and we have to be in a position to advocate for it. So we have to have our ducks in a row as it relates to the cash flow and why we're counting it as such. Other considerations is that cash 100% of the time stays with the seller. I needed to bring this to your attention, is that unrecorded revenue. So if you're skimming, just assume that it's gone. No one is going to give you credit for anything that can't be proved. And the same thing with inventory. Okay, so there are times where, you know, it's a wink wink nod nod. Well, who's going to write a check under those conditions? And it's just hard. And so if you're one of those sellers that is not reporting all of your income, I would say, you know, take a year or so, pay your taxes, because it will pay dividends when you do go to sell. All right, so moving on, this is our recasting exercise. So I'm going to have to change gears into Excel. So give me 1 second. All right. So let's begin with this is the income statement. And again, this is an actual business, and you can see all the financials. So I have your directions here. So first, you want to download or input your income statements and balance sheets into a comparative format. And when I say that, we want to be able to look at it side by side. And the reason is we're looking for anomalies. So here are the actual financials. This common size, what I want you to take from here is that this is, let me see, this is, in this case, cost of goods sold divided by gross revenue, okay? We look at that all the way through the income statement, okay? And the reason I do that is I want you to see anomalies. So let's say, for example, why don't we say auto leasing? Say this is $6,000 right here in 2015. Why don't we say $60,000? You can see that, you know, if I'm looking year by year, well, why is this 2%? And it prompts me to look at this number and ask myself, well, what happened? So even though if you're doing it yourself, this is important, because as you scan through here, you're looking for just anomalies. And I'm telling you, this is exactly the process that I go through. Okay, so you're just scanning down. The other side is you want to see what the changes, okay, what the changes in growth are. So again, okay, I have the formula set up for that also, and you just have to put in these numbers and it'll calculate it for you. So as we're looking through, we've now you can get, I don't know if, yeah, I believe it does. So for those of you on QuickBooks, you can just go to one of your reports and you can do a comparative analysis, and it will export this into Excel. Okay. So you're looking for areas that draw attention, like here, bad debts. Let's see some other things that I'm looking for. I'm looking, you know, there's some travel here, meals and entertainment, other income. You know, I'm just looking through it, because what happens is I'm going to come over here and I'm going to put it on my SDE sheet. So when I'm presenting this to sellers or buyers, I want it to be in a position that, you know, here's a summary of my income performance, and then we talk through our cash flow. So remember, we start with our net income, we add the interest because it's not included in anybody's capital structure. We add depreciation if there is any. We add the officer's comp. We add the payroll taxes associated with it. And then we look for then we add our discretionary expenses. So our bad debt, our pension, and profit sharing, you know, that's indirect compensation to the business owner. We've got travel, you know, this tools and other expense. These are non-recurring events. And then we have meals and entertainment. We then move into, I was telling you about rent. In this case, we did a real estate appraisal, so we found that it was indeed fair market value. So here's my actual rent, and if say it was $150,000, you can see it will reduce my cash flow by that 44.4. Okay. So like I said, we identified these areas, we complete our cash flow sheet, and then we move over to our balance sheet. So our balance sheet, same kind of thing. So I've spread it year by year. Okay. You can see my income or my assets and liabilities. I do the same analysis that I did on the income statement. I'm looking for changes. I'm looking for, why is my AR so much higher these days than it was in 2014? What has changed? It just prompts the question. There's nothing necessarily wrong. It just, I want to know why. And the same thing down here. Are there anomalies that require a question? So that's more, for informational purposes, but for the sale process, we move into the economic balance sheet. So if you look at column Q, we have 125,000 in cash. Seller's going to retain that, like I told you before. Accounts receivable was 637. Now, the buyer can buy the receivables, or the purchaser, or I'm sorry, the buyer can buy the receivables, or the seller can retain them. It's totally negotiable on that side. Your purchaser will acquire these tangible assets. This is the estimated market value of those assets. One of the questions that come up a lot is there a rough rule of thumb to determine fair market value of assets? So rough, and again, even though I'm an equipment appraiser, I mean, you do have to dig into value, but if you're just trying to kind of get a rough idea, you want to start with roughly 50% of the original cost of that asset is will get you in the ballpark, albeit a big ballpark. So the buyer is buying your assets. If there was intangible assets, for example, say it was, for lack of a better example, let's just say it's a Subway sandwich shop. The intangible asset of the franchise would also be included here. Okay. The seller would retain other assets. So from this, the takeaway is they're buying maybe the accounts receivable. If there was inventory here, they certainly would be buying it. They would be buying tangible assets, and they would be buying intangible assets. Everything else stays with the seller. On the liability side, again, if you're taking, we always say it's cash-free, debt-free from when we work with our sellers. So if you're taking the accounts receivable, meaning if the buyer is buying the accounts receivable, they should be buying the accounts payable too. So that's why I said seller or purchaser will keep. The seller is responsible for taking care of all the debts. Okay. And then as far as the equity, this is an asset sale and this is immaterial. Okay. So that is the example. We're going to upload or share with you this exact spreadsheet so you can put your information in and calculate your cash flow and your economic balance sheet. Okay, so questions that came in. How do I set a value? Well, that's a loaded question. I think it's Abraham Lincoln that says anybody that is a that represents themselves has a fool for a client. Well, it's tough on trying to determine how do you set a value. What I would tell you is that however you do it, you have to still answer those 3 questions I told you. How much can I make? How much debt can I service? And how much of a return of and on my investment can I get? So when we do that, that will kind of set your price. I always, I guess, when I look at a business, or if I'm trying to rough it out, I would say that you you need to you take it back, you calculate your cash flow, you back out a fair market value rate. That leaves you an amount that is available for debt service. You adjust that down to cover the debt, and that debt coverage ratio, and we'll talk about this at a later date a little bit further about that debt coverage ratio, and that's about 1.25. So you that's the amount of debt that the business can pay annually for the debt structure, and that should be able to back you into it. So you're looking at probably a 5 to 7 year debt schedule. So if you need more, seriously, just call me and I'll walk you through it. And then lastly, how do I make the business available for sale without locally impacting my continuing sales effort? Okay, like I said before, I mean, professional representation is always a good idea in situations like that, especially if you're forced to navigate in anonymity. So I guess my initial thoughts for you would be, how do you preserve the confidentiality? In the brokerage here, I mean, that's the cornerstone of our practice, and we're able to reach out and have those conversations, and we're just doing our job. In your case, you got to figure out how to do that. And I mean, I would probably set up a PO box, perhaps a Gmail account, you know, nondescript, so you can navigate, you know, the buyer pools without sharing who you are. That would be my at least my initial thoughts. The other thing that I would caution you, especially if you were a candidate for a competitor, you need to really be sensitive to how you approach the how you approach those types of buyers, because again, if competitors get word of it, you're not selling your business, you're going out of business because it's a competitive advantage. Okay, so let me come back here to, and again, back to the questions. You know, you can call me at any time. I'll let you know well in advance when I got to turn a meter on, but I'm happy to talk you or anybody else through the process. Okay, so our next webinar is May 16th. We're gonna do even a deeper dive on some of the attributes associated with why buyers buy, drivers of business value, and how they're looking at your business, specifically, not only just financially, but intangibly, because a buyer has to understand and feel the business. It has to be there's an emotional connection to why they're buying, and that's going to be the conversation that we're going to have. Okay, so again, thank you so much for your time and attention. We hope that you found this meaningful. If we can ever be of service, you can reach out. My contact information is there, or you can give us a call at 317-573-2100. Thank you so much and have a great day.